Okay, then, good morning, good afternoon, and good evening, everyone. I'm Giuseppe Basile. I'm going to be the host for this presentation. I want to thank Adinda and Vicky from fxtrade.com and fxtrade.com for inviting me in having this presentation. Today, I'm going to talk about high-frequency trading, and particularly practical considerations when we have to factor in high-frequency trading and consider its effect on price. So high-frequency trading is important in a way that it can affect some other classes of algorithms. My name, I also have a nickname, Fib Stalker, and that's the way I'm known in the trading environment. So let's look at the agenda. I will provide a brief introduction to high-frequency trading, and then I will talk about two major effects that high-frequency trading can have on market price. And I will also touch very briefly on what is going on different classes of algorithms. Algorithms is what I study in my trading. My trading edge comes from looking at the effects of algorithms on price. And I use that information to actually get an edge and actually to identify opportunities to enter in the market. I enter in the market when confirmation is given that some classes of algorithms are also entering in the markets. And finally, I'll talk about the effects. In one example, I talk about the effects of program trading, of high-frequency trading on other classes of algorithms and that attempt to frame price structure like program trading. So, if you have any questions, I will split the presentation in different chunks, and I'll stop and ask you for questions. Of course, risk is very important, is paramount, always very important to consider that trading Forex and any other asset classes carries a high level of risk, and minding risk and minding money management is very, very important. When the money is gone, the game is over. So if you are actually watching this presentation, the recording of this presentation, stop the presentation now and read this slide here. About myself, very briefly, I presented a few webinars on FS Street. You can watch the other ones as well. Why I'm qualified to talk about high-frequency trading? I've been studying this in the last 4 years, and I published 3 research papers. 2 of them were dedicated to algorithms, and 1 paper particularly was dedicated to high-frequency trading. I'm not going to go through all this. I started in 2001. I'm a CMT. I have a master's in finance. I'm a computer science engineer, and in 2009 I started trading full time. I have over 17,000 hours of market exposure and price exposure. This summer I launched fibstalkertrading.com, where I host a coaching program and I teach what I know when it comes to identifying participation of algorithms on price. And I also teach the fib stalking timing technique, which is a proprietary technique that allows to time the market based on what algorithms, a class of algorithms, is doing on a smaller time frame. So let's start then and let's look at the reality of modern markets. Modern markets quite a different animal. If we compare them with just what the structure of the markets was only maybe 10, 15 years ago. And there is a lot of activity from algorithms in some markets, like the futures, for example, that participation is up to 80%. That was in 2009 or in 2014, so that could be much higher. In Forex, the estimate in 2006 was 25%, and it's known to be between 45% and 50% now between 2010 and 2014. For options, the last estimate I have is 2010, 20% of options. Of course, high-frequency trading which reaches a big chunk of volume in the European and American financial markets in 2011. It was estimated between 35% and 75%. There's also program trading that is estimated between 20% and 30%. This is a very important class of algorithms. That's what I follow. If you want to review the sources, you can find information here. One very good source is the documentation created by the UK Government Office for Science, and I recommend you get it if you want to understand a little bit more the high frequency trading phenomenon. So high frequency trading has an effect on market price structure, and I'll tell you about market price structure later on, what that means. But high frequency trading is a class, it's a family of algorithms, and they actually it's a class that attempts to obtain an advantage, and I believe it's in a non-orthodox way, in a very unfair way, in my view, in the markets. And this class of algorithms is capable of exploiting small differences in price between different markets, and this could be two different stocks, could be the ETF versus the single stocks that compose the ETF. It could be a future index and the equity cash index, the S&P 500 cash, and so on. So these price differences are exploited through a very quick, ultra fast execution of trades, and sometimes they are in the order of milliseconds. Of course, in order to execute this trade, is important. It is important that there is a dedicated infrastructure in order to allow these algorithms to execute so quickly. So there has to be a computerized infrastructure and a dedicated network attached directly to this infrastructure, directly attached to the main electronic markets. And we're talking about here AMEX, NICE, Nasdaq, CME for futures, but also Eurex in Europe and LSE in London. So let's provide a very quick brief definition of high frequency trading. There are several definitions of HFT, and the definitions also varies, but there are a number of attributes that are common to all high frequency trading algorithms, and definitely one characteristic is that market positions are acquired and removed very quickly, sometimes 100 or even 1,000 times a day. So these algorithms, they actually put on a lot of trades, and there is also, as I mentioned before, a very low latency in the transmission of the orders to the markets, and that's because these algorithms, they run on computers that are attached directly to the main exchanges. Another characteristic is that they don't carry inventory. So sometimes, well, very often, high frequency trading is compared to old market making. But the difference is that market making in the past was based on investments of millions, if not hundreds of millions, and market makers would carry a lot of inventory, and that means they would carry stocks or their contracts or lots in case of forex overnight, and that is not the case for HFT. At the end of the day, HFT close with little or no inventory. Positions are typically closed in minutes or even in seconds sometimes. And as I mentioned, very rarely a position is carried overnight. That doesn't happen for HFT. One last and very important characteristic is that the ratio between the order inserted and the order executed is very high. Means that, and this can be as high as 10, as high as 100. It means that out of 100 orders inserted in the market, only one is executed, which means that these algorithms get a lot of cost demands and cost supply, and that's the way they game the system. So is high frequency trading a way to obtaining trades in a more convenient way, providing providing and offering volume to the market, or it's just a way that modify price structure? Well, it is my belief that high frequency trading disguises as market makers, but in reality, and market makers should actually increase liquidity. The reality is that under market stress, all this liquidity is removed. And I'm going to show you a very clear example of how that happens. So high frequency trading does not do any type of directional bet. They don't take a position in one direction in the direction in the market, but they simply game the system in my view. Now, how and why high frequency trading can be dangerous? Well, it can be dangerous because it's established and it's based and establishes in the market a key mechanism, which is very well known in system engineering. That's called the self-reinforcing feedback cycles. And you might have experienced this, and that's exactly the same thing that happens between a microphone and a speaker. And sometimes you went to parties and something strange happened. There was noise coming from the speaker that actually feeded back into the microphone and so on until you get very, very high noise with the danger of breaking the speakers. And that's exactly the same process here. The effect of a small change in a system, in this case, in our case, in the market, that cycles back into the market and produces a greater change, and so on. So as that happens, the risk amplifies, and there are interactions that are unexpected and undesired. Likewise, the interaction between the speaker, the output of the speaker, and the microphone. And that happens also in financial system and financial processes of management and control that were defined and designed with positive intention. So the problem is that you can have this self-reinforcing feedback cycle also in systems that were initially designed with the best intention in mind. And these little changes that can create instability can be driven by volume, volatility, can be driven by market news as well. Some high frequency trading, they analyze the text of market news and they act automatically on them. And there can be delays in distribution of data as well. I'm going to show you an example of this delay in distribution of price. Now, there are a number of ways this instability, self-reinforcing feedback can be put in place here. I'm not going to describe each and every of them. I'll just focus on the one here. I would like to annotate, but I don't know if I'll only focus on this one. And this may well be the feedback cycle that was responsible for the crash in the 1987. And the delta hedge, which is a way of hedging a position in stock uses options, is very common. Actually, it's still very common today. And what happens is that when there is an effect on the index, so for example, there is a strong selling in the index, the delta hedge has to be adjusted, and as a result, there can be a sale of stock, which actually cycle in again, and actually the cycle is closed. Now the index keeps falling, the delta has to be adjusted. As an effect, more stocks have to be sold, and so on. So that's the kind of effect that you can get. Now, I want to look at an example, very, very real example, and actually it happened at the beginning of mid of October. I'm going to show you in detail. This is a specific specific instability feedbacks. Large price move on the downside, and plus we need a small delay in price quotations. And when that happens, these two conditions happen. What happens is that high frequency trading algorithms try to redirect orders to other attractive markets, to other exchanges. And that only because apparently the price on those exchanges is perceived to be better. But the reality is that it's not it's not because they are better, it's just because they are perceived to be better. And when that happens, actually, they look more attractive, but only due to delays. And when that happens, then there can be delays, they move deeper and deeper and fall deeper in the market and grow bigger. So the delay worsen. And so the price timestamps of the, which is the date and time information attached to the price information actually becomes more and more misaligned, and so then the cycle closes, and it amplifies the quotation feedback cycle. So it means that the delay in the quotation that are published by an exchange, in this case it's NICE exchange, it's larger and larger, and the whole process repeats and amplified. So is this theory, or is just I'm just trying to show you something that a concept here? No, that happened in reality. And the last example was a dump of 750 million worth of stock in 1 second. In 1 second, and that happened on October the 13th, 2014. So just only a few weeks ago. In 1 second, at $750 million was dumped on the market. And what was the result of this forced liquidation? Of course, when that happens, there's only one way the market can behave. And when there is high frequency trading, and that's a collapse of all liquidity. Now you have to consider that the SP 500 is the most liquid equity exposure vehicle in the world. So look at what happened after that 1 second. And I'm going to provide some charts that are offered by Nanex, which is one of the company that studies the effects of high frequency trading on the market, and they have this size map I'm going to show you in a moment. What happened to the SP 500 mini? In less than 1 minute, lost 9 points. Bam! It was very quick. So this is the picture of what happened. And I want you to, let me see if I can annotate this. I want you to focus on two things. First of all, look at how the market broke down very, very quickly. And this is, this is 1 second. And look at, most importantly, at the volume and liquidity here. We were around 5,000, and soon after that event, that is identified by this long volume bar here, the the volume reduces of a factor of 5, maybe 10 here. So that's the why that happened, because high frequency trading actually removed all the liquidity from the markets. Okay, and that's a better view on the SP 500. What happened to price? Just in less than 1 minute, nine points, and this is the volume event there. Now, I want to show you. It's more clear on this second example here. I want to show you in that specific event. Let me see if I can annotate. I want to show you the difference between the quotes, which are this, and the actual bid in the market, which is at a lower price here. And this color is probably not the best choice, but these little bolts here are the where the bid is, and this is what the market is reporting. This is the price that the market is reporting. Clearly, at the end of these 1 to 2 minutes, the market quotes and the bids, they are aligned again. But look at how delayed become the quotes from the market. That's quite fascinating, I believe. So these are the quotes, these are the bid, and where the actual trades take place. Okay. Are there any questions so far in relation to what I just presented to you? And in the meantime, I want to say hello to Kausala, hello to Andy, and do you have any questions so far? If not, I will continue. I understand that so far it's very, very conceptual, but I'm going to to show also an example. So one question is that the spread between bid and ask or what? No, that's not the spread between bid and ask. That's the spread between the quotes that the exchange is actually publishing, which are these are the quotes that are being published. But because those quotes are delayed, the actual bid are here. So the quotes appears to be higher than the bid, the actual bids. And the reason is that because there is a delay in the quotes. Okay. So hope this answered the question. And the other question, can you go back to the previous slide? And the previous slide would be this one. That's the same phenomenon here. Okay. So let's continue because I have a little bit more to cover as well. A market price structure. What is market price structure? You can think very simply as the way market price evolves. In reality, there are several definitions about that. And the price structure is, I consider it healthy or robust if it is liquid. If the market is liquid, which is there is large volume of exchanges, there are a lot of exchanges. If the market book is deep, which means that at each price level, demand and offer are rich. There is a lot of contacts being exchanged at each price level. And actually the book is also deep. There are a lot of these price levels. And of course, as a result of 1 point and 2, the spread is small. And this is the spread between bid and ask. So in these conditions, liquidity providers are rewarded. Who are these liquidity providers? Liquidity providers are, as I'm going to show you, participants on the smaller time frame that provide actually volume to the participant to the highest time frame. And this is a very, very important point to understand. Always think about the liquidity provider and whether they are rewarded or not. If a market liquidity provider is not rewarded, then the market becomes unstable. And what happens when the market is unstable? It happens exactly what I showed you before. There are market crashes, and I don't know if you were trading on May 2010. I was there that day, and I didn't have any position on the SP 500, but I saw that happening, and apparently that happened because of a mistake of an algorithm that sold 75,000 contracts in the SP 500 futures. And that happened in the space of 15 to 30 minutes. So let me show you the difference between a healthy and a healthy price structure. So a healthy price structure is a structure like the one that is presented here. Now, in order to describe this, think of these two lines as two different players in different time frames. The black line represents, let's say, the 4 hours. And the broken dot and blue line here represents the activity on the 15 minutes, for example. So let's suppose that there is a group of traders, swing traders, who actually identify the fact that this market is going to reverse, so it's about to reverse in A, and they buy around A. Now, there is another group of traders on the smaller time frame that might believe that this market is due for a correction, at least on the smaller time frame. And let's say that they sell at a primes here, and T2. And now, what can happen is that, let me see if I can annotate this chart. So what can happen is that these people believe that the market is going a little bit lower here. The people in A, and by doing that, they have to sell the market. So they offer liquidity to the participants, the larger time frame, who keep buying this price because they believe that price can go even higher than B. Okay, so the participant on the smaller time frame provide liquidity, so they sell, and the participant on the larger time frame buy. Now, let's suppose that the participant on the smaller time frame do not sell here, but they keep this position. At some point, they show a loss, and this loss is represented by this difference here. Now, if they wait long enough, this market eventually corrects, and they can actually start exiting with a gain at these levels, and they can even and they can even reverse their position if now believe that the market is going to continue higher. So as you can see here, a healthy market is a forgiving market for these players on the shorter time frame, because they provide liquidity, but they also have an opportunity to exit if they're real positioned in the market. So this is a definition of an healthy price structure. Now, let's look at an example of an unhealthy price structure, which is what you see on the left here. Now, as you can see, the difference immediately, you see, let me see if I can annotate this. Here, the difference is immediately the fact that, first of all, the market and so as a result, it's very easy for our liquidity provider to show a loss. And actually, in this case, in this example that I'm showing here, the market on the larger time frame retraces into C, and this actually guarantees a loss to the liquidity provider. So the point is that by not retracing, the market actually generate a loss very, very quickly for liquidity providers. And there's an effect, liquidity providers leave the market. They show a loss and leave the market. And that's exactly what happens when program trading actually abandons the market when during stress conditions. Okay, so that's the main difference between a healthy and unhealthy market. So how it all matters to my trading specifically. I know, and we know, the market moving trends, and that can be proved formally as well. And I take opportunities, and that's my suggestion as well. You should take opportunity to trade low risk trades in retracement. That's where the real business is. I don't trade breakouts, for example. And the presence of modern markets is massive, as I showed you. So this gives us an opportunity to piggyback and follow and study what huge big smart money algorithms are doing, and specific class of them. And I use a technique I call flip-stalking timing technique that I use to time the market by looking at what happens to these algorithms in the smaller time frame. And actually, I know today there is a participant of my current coaching program I'm having, and started in October. The next one is going to start in December. If you're interested, just let me know. And of course, there is high frequency trading, and this makes the market riskier to trade, as I showed you before. And there are some high frequency trading algorithms that trade on news. I don't trade on news. I don't believe traditional tech analysis is effective, and the reason is that the indication you can get from traditional tech analysis, lag price, and when you do a real trading reality check, it shows very low reliability, 50%. When you add mistakes, cost of doing trading, slippage, and so on, you can go down to 40%. That's the reason why 95% of people lose money in the market. So why then adopt a 30% or 40% reliability method when we study algorithms at 70 or 80% reliability? And that's a fact. Now, let me show you, and I'm going to close with these examples. Maybe before getting into this example, if there are any additional questions, please let me know. Are there any questions in relation to what I presented so far? Go ahead, you can write it on the chat, otherwise I will just continue. Okay, there are no questions, or I can answer your questions later on as well. Let me continue here, and let me show you an example of what I believe it's a very visual way of explaining the war between, or the battle, I would say, between different classes of algorithms. And this is an example I identified in December last year, and it was on a news day on the SP 500. And when I look at this chart, and of course I need to annotate this chart. When I look at this chart, I want to show you, first of all, here in C there was a valid, let me see if I can annotate this chart, it's very important. apparently I cannot. Okay, so there was a valid measure move, which is a trace that I use very simple. This is a 50% retracement here. There are more complex traces that identify and model price structure. In this case, the market reacted at C here. And as you can see, before the news that happened here at the point D, the market moved laterally, basically. Okay. What is interesting is that the market started moving lower and never broke this 1766 level here. And I use these levels to validate or invalidate actually my trades. And let me see if I can keep annotating here. And the market then started moving lower here and went just above this level that I used to validate or invalidate trades. And then in 1 minute during the news, what happens is that the market went to break this level. Notice that the market did not break the lower level A. So you would traditionally expect that below this level there are the actual stop loss, right? Below this level, typically in professional go and fish for stop loss. But the reality is that this market only broke this level. And this was a valid level for a valid setup, higher, having first target in 1793.75 and second target in the 1766 level. Okay, so it is interesting what happened here, because the reaction to the news, which could be, of course, emotional moves, but also high frequency trading because of the speed with which this move happened, broke this setup, and then eventually the market reversed and brought pricing right into those two targets of that setup. So let me show you on the smaller time frame here what really happened. First of all, in 1 minute, that's what happened in 1 minute here. Let me see if I can annotate. In 1 minute, the market actually went down to break that setup, and the setup was, I want to remember that the setup was actually, let me see if I can annotate here, and apparently I cannot, so here we go. So the setup was, the stop was actually around here, right? So program trading a class of program trading went to stop that entry from program trading. A class of high frequency trading went to stop that entry from program trading, which is a powerful class of algorithms, but then eventually reversed the market and broke market higher. Now, I want to show you one thing. Initially, the market did not retrace into a lower level here, but stayed at a higher level, at the higher level C. So there was no way we could identify this level before the fact, and we could only identify this level after the fact by identifying this anchor here, this level I traced the Fibonacci from. So when I traced after the fact, after seeing this reaction in C from A to B, I could identify this level, but only after the fact. So this level could not be traced before. It could not be traded as well. The same thing happened after the market moved above D here and into E, into this level here. If I traced again from C to D, I could not capture this level F. And I could only capture this level F if I traced from D to E. Okay, so these two yellow arrow here demonstrate and show places where due to participation and due to potentially lack of control from program trading, it was not possible to anticipate this trade. But as the market started digesting the news here and actually program trading comes back into the market and into the smaller time frame. Let me remind you that this is the 1 minute time frame. we can see that becomes more and more regular. And in fact, now the next measure move, which had the support in H, now it's possible to anticipate the move, because when we trace from the low here in F to the high in G, we had a few minutes to position ourselves and take the trade in H. Okay, of course, there are ways of confirming whether in H there would be participation or not. And the same consideration we can do between this low in H and this high in I, which gives us another level of participation, L here, which brings price into these first targets. And these first targets, they can be identified as soon as the trade, as soon as this area of support in H and L is identified. So this is a demonstration of two things. The first thing is that activity of program trading can actually go and break the setup of a larger and stronger algorithms like program trading, which is modeled here by this ABC. And the second fact is that whenever the effect of high frequency trading or emotions on price wanes, then program trading and some strong algorithms that control the market actually regain control here, and this is showed by what happens in C and F compared to what happens in F and L. So this is what I wanted to tell you today in relation to just brief examples, some examples of how high frequency trading can actually affect other algorithms. Of course, all this implies that there are algorithms that define and actually force a structure on price in certain conditions, and specifically when there are no news, or when the news is actually now digested by the market, and also when there is no intervention from the central banks and there is no geopolitical event that is hitting the market. So this is it. If you have any questions, you can write them in the chat. If you want to look at a little bit more of what I do, you can come to my blog. There are a lot of videos. There are over 600 videos. There are a lot of articles on high frequency trading as well. You can go and search for high frequency trading. Drop me an email if you want to receive more information, and also if you want to receive information on my coaching program. And I have a free newsletter that I send twice a week, and you can subscribe for free. And I also provide market analysis using my method. So I have a question here which says, what happens when high frequency trading, program trading moves against each other? Also most of the smaller time frame action is random. Well, in reality is that it's random if the volume is not high of the market. In high volume, the structure is quite regular. The reality is also that, and when I talk about high volume, I speak about high volume stock, forex, the biggest pair, excuse me, the biggest pair, the equity futures, some commodities like gold, for example. So the reality is that algorithms trade against one another, and even algorithms of the same class. So it's not random. It's random in a very, very smaller, in the smaller time frame, 1 minute or so. But still, even in that time frame, you can identify a structure. And what I showed you here is very, very common. What I showed you here, there are different ways you can. Let me see if I can annotate. But basically, what I showed you here, it's very, very common. It's possible to anticipate the structure of the market. The other question is, do you have a video which explains in detail how you draw the fibs? No, that's part of what I teach. But if you go to my website, you find a lot of examples which I don't explain what I do, but I show the traces and I show how these traces. See, I show this in a very small time frame here, and each of these varies 1 minute. But I show those trades in several markets, also in the newsletter, in the market, in the midweek market review, and in the weekend market review. I show those traces when I take those traces on the daily time frame, weekly time frame. Those traces are show area of participation with days and weeks in advance. Okay, so my suggestion is that just subscribe to the newsletter. I mean, get that information. Look, go to the website and search for the videos, and you will see these traces being very relevant, and now they actually anticipate potential participation. Now, I never take this level blindly. What I do is that let me show this on the previous chart. So when I identify a level of an area of potential support or potential resistance, like in this case, if I can annotate. So when I identify an area like C, I never buy blindly. Actually, what happens is that I use the Phipps token timing technique, which is that technique that I mentioned before, and I look at the sequence of the measured move into this level, the counter trend of this counter trend here. And in this counter trend, there is a structure as well. It is brought about by the same algorithms that are working on a smaller time frame. So, and this can be used in order to confirm the support, the participation of algorithms at these levels, okay? So that's the way I look at the market. As you can see, I look at the market in a totally different way. I don't look at the market using technical analysis. I use naked charts and just a variation of Fibonacci that models how these programs participate in the market in all time frames. So I never buy blindly. I need always confirmation, and that confirmation is provided by the algorithm themselves. You're very welcome, Joe. Is thanking Joe. And is there a link on your website where one can view the newsletter? Yeah, you can go to. Let me see if I can show that to you here. And this is my website. These are the statistics of my websites, and this is my website. So you can go here, and you can sign up. Just a few seconds, and you can go and actually. Sign up for the newsletter. So this is really it, I think. I mean, if there are any other questions, otherwise I want to thank you for being here today. This edge that uses algorithms is very powerful. So read about it. Read on my website, and it's a lot of proof that that's the way modern markets actually work and offer you the opportunity to enter at a very in interesting spots, something that traditional technology cannot provide. Now, just forget for a minute what happened here. This is not what happens normally. In fact, I showed you here a situation where I wanted to show how algorithmic trading opposes these other classes of algorithms. But this is not common. So if you look at the market like this, you would have had the opportunity to enter maybe here with a stop below lows and enjoy this move higher. Enjoy just in a day, just in this move, maybe a 4 to 5 reward to risk only on this move. And of course, the real money is on the swing trade. So when you enter on the 15 minutes and then you bring your trade into a swing target, that's where the real money is. Okay, so this is it. Thanks a lot for being here today, and I hope you you liked and appreciated this presentation. Program trading and algorithms are real in the market, and you can get testimonies from people who are looking at the way I trade actually. And so go ahead, subscribe to the newsletter, or just ask me questions. I'll be happy to provide answers to you. If there are no other questions, I would close it here, and this saying thanks, useful, enlightening. I'm happy, if I reach my objective, because I want to bring you analysis only fits data, right? When you start adding rules to your indicators in technical analysis, you're just fitting the market data, and the more rules you add, take supply and demand for example, and the more fit to data that your system becomes, and so that it is not able to adapt to what the market is offering you. In the case of algorithms either they are there and they participate in the market or they're not. So if you have a way to identify whether that algorithm is participating to a level that you can identify well in advance, now you can actually take the trade confidently, and that's the reason why when you take the trade like this, your reliability goes much higher. Okay, so thank you very much then for your attention. If you want to watch the other webinars on fstreet.com, it's not the first time I talk about algorithms and program trading, so you can also watch those webinars as well, and drop me an email if you want additional information what I do, and also on the coaching program is starting at the beginning of December. Okay, so thank you very much, and wish you a very good day, and I'll see you next time on fstreet.com. Thank you to fstreet.com for offering me the opportunity to actually present this practical consideration of the effects of HFT on price. Thank you very much. Bye-bye now.